So now we're getting to the meat and potatoes of the tax code. We're going to start talking about small businesses, business income, and taxes that affect your small business. And I call this my meat and potatoes because this is where I make the most of my money from my clients, is helping them with their small businesses. Right now, you may not be thinking you're going to be self-employed one day. I certainly didn't think I was going to be self-employed when I was in college. But you'll be amazed at the number of times people start a small business and they may not even realize that they're going to start a small business. They might think they just have this plan to sell a few things on the side, but in reality, that is a small business, and there's lots of rules that go along with starting your own business. So let's start taking a look at some of them right now. Okay, so first let's talk about what is a trader business. And quite simply, it's anything that you do that you're trying to make a profit from, whether you make that profit or not. So as long as you're trying to make a profit, even if you lose money, it's still a trader business. These ones you're all probably very familiar with. All of these are traditional businesses. These are some of the most popular ones that I deal with around here. And then you have some not so traditional ones, but these are just as likely for you to encounter or even start yourself. You know, a lot of the selling things where people sell products to their friends and try and get all of their friends and family to buy these products, that is a very popular thing these days. And so all of these are small businesses. Some of the lesser known ones, you know, babysitting, you might just think you're doing it just for some pocket change for the weekend, but in reality, it's a small business. This is a big one down here on Main Street in Denison. We get a lot of people walking through our front door trying to sell us cookies and some really good tamales. And again, they're just trying to make a few dollars for their family, but it's a small business. Private lessons, another popular one. Music teachers, tutoring, they all do some side work, and very clearly a small business. So the one thing I want you to realize is that all of these businesses are going to be treated pretty much the same way for the tax code. There's some little different rules on how we might treat certain things, like whether or not you have inventory. You know, a music teacher may not have inventory per se, but obviously somebody who's selling something would have inventory. And there's some special rules for that. But other than that, all of these are going to be treated on the tax returns the same way. So again, pretty much anything you do where you're trying to make some profit is going to be a business. And it doesn't matter how small it is, whether you're just making $100 of profit a year or $100 million of profit a year, all going to be treated the same. It's all going to be business, and you're all going to have some tax consequences with it. Now, most of the businesses that we deal with are reported on a Schedule C, and this is the 2017 Schedule C, but in reality, I would be hard-pressed to figure out what the differences are between a 2017 and a 2020 Schedule C, because they've looked like this for quite some time now. The most recent change was down here with the home office use, and we'll talk about that here in a minute. So this is a Schedule C, and you know, like we looked at in Chapter 1, I believe it was, they all have the same thing. We have your income sections, your expense sections, and then your net profit sections, and that net profit section is the name of the game. This is where we're going to try and figure out how we can get this number as low as we can for a tax point of view, so that our taxes are as low as possible. So this is generally filed by sole proprietorships, and sole proprietorships really just means there's one person doing the business. I don't care if your spouse is helping you out or whatever, but generally you have one person who's in charge of the business, and it goes in their name. And you can see here, we either have to list your social security number right here and the EIN number if you have one. Most small businesses don't even have an EIN number. So we have to tie it into one person, and that's why it's called a sole proprietorship. One person is going to be responsible for all this, and that comes with some other issues that we'll talk about here in a bit. The Schedule C, yep, just like the Schedule E's and F's, they all look pretty the same: income, expenses, net profit. And you can have multiple Schedule C's. You know, maybe you paint houses on the weekends and give guitar lessons during the week. Those two are pretty unrelated businesses, so you would have two Schedule C's, and you'd have to keep up with your revenues from one business separate from the revenues of another business. Same thing with the expenses, and this is where it gets complicated. There's no limit to the number of Schedule C's you could have. You might have 50 of them on there if you want. You just report them separately. Of course, record keeping for 50 Schedule C's would become kind of a nightmare, but it can be done. We do try to group things together. So maybe you paint houses and you fix up houses. You know, those are pretty similar. It's repairs and maintenance on residential structures. So we might combine those, even though you maybe consider them separate businesses, but they could be easily combined right here. So let's talk about what you can deduct. And this is the big one. This is where we get lots of questions from our clients. You know, the income side's pretty easy. Every dollar a customer gives you for providing that good or service is your income usually. But the expenses or the deductions are varied, very, very different expenses, because, you know, a CPA is going to have different expenses than somebody who's building a home, and they're going to have different expenses than somebody who's a painter selling paintings during the week. So we all have different expenses, and that's where I get a ton of questions. People always call me up and say, Joe, give me a list of what I can deduct. And I tell them there's no magic list. I don't have a list. One doesn't exist, but there's an easy rule of thumb. And this is what I tell them. I tell them, if you spent that money to help you earn that revenue, then it is probably a deduction. So if you've spent $1 to help you earn that $1 of revenue, we are probably going to be able to deduct it in one way or another. This is one of the biggest questions I get asked every year. People call me up and say, hey, I spent $500 buying a new printer. Can I deduct that? And then I ask them, well, are you using that printer to help you make money in this business? And if they say yes, then I say, absolutely, we can deduct it. But if they say, no, I just bought it so my children could print out their homework, then no, it's not part of your business, so you don't get to deduct it. And we'll get into pro rata portions later. You know, what if they say, well, I use it half the time for my business and my kids print out their homework half the time? What do we do then? The quick rule is we just deduct half of it. So there's 3 tests to decide whether or not you can deduct an expense. And this first one is the catch-all to get everything. You've got to pass this test or everything else doesn't even matter. Is it ordinary and is it necessary? And so one of the examples I use is, what if I had a helicopter to fly me around to my clients' offices here in Grayson County? Is that ordinary? No, not really. Is it necessary? Well, absolutely not. We can drive anywhere in Grayson County in 20 minutes, so we really don't need a helicopter. So if I had a helicopter and I was flying around to my clients' offices, I think it would fail the ordinary and necessary expenses it would fail the ordinary and necessary treatment. It would fail these tests, and I would not be able to deduct the cost of my helicopter, the fuel, maintenance, and all that good stuff. And so it would be unwise to try and use a helicopter in my business. But now what if I run an offshore oil rig? Is it ordinary and necessary to have a helicopter to fly the employees out to the offshore oil rig? Well, absolutely. Oil rigs offshore frequently fly their employees out there by helicopter, and it's absolutely necessary to get it out, to get their employees out to the platform by helicopter. Sure, you could take a boat, but that might take a lot longer because these oil rigs could be hundreds of miles offshore. And so it is ordinary and necessary in that case. So this is an example of where a helicopter would be deductible. You must have a business purpose for this expense you're expending. And that's where I go into asking them, you know, when they call me up and say, can I deduct this? I say, well, do you have a business purpose? Why did you buy it for your business? And if they can say, oh, well, I needed it to produce more product, then absolutely it's going to pass the business purpose test. And as long as it's ordinary and necessary, then we are on a good track to be able to deduct it. Now this one is a little bit more of a gray area, and I always tell people, try and make something a business purpose. You know, a cell phone is pretty common. People will say, can I deduct my cell phone? And I say, well, do you use it in your business? And they'll say, well, you know, once in a while I might make a call. And then I'll say, well, you know, if it's just once in a while, we're probably in that de minimis rule and probably not going to be able to deduct it. But is there a way we could make it deductible? What if you put your cell phone on your business cards? What if you made more calls on your cell phone? What if you did your ordering from whatever vendor sites you use from your cell phone? Now we could start making the argument that we are using it for the business purpose. It is ordinary and necessary to have a cell phone. So now maybe we could get to where we could deduct a portion of our cell phone. So this is a big one. We want to try and get it to have a business purpose if we can. And is the expense reasonable? Like we were just talking about the cell phone. Is a $100 a month cell phone bill reasonable? Absolutely. Is a $10,000 a month cell phone bill reasonable? Nope, not at all. So this is where you might pass all these tests, but it's just an unreasonable expense. And this one we don't really encounter too often because it's just most of the expenses that you're buying are reasonable. It's fair market value of whatever you're buying from whatever store is going to be a reasonable test. This really exists to help preclude people colluding behind the scenes. Like with another business owner, I might say, well, I'm going to give you an invoice for your tax return for $50,000 and you give me an invoice for $50,000 and we can both deduct it. Well, you know, now we're failing the reasonableness test. So that's what this is here for, kind of a catch-all. This is what it looks like when we have a nice list. People often will bring me in the shoe boxes full of receipts and all that, and I tell them, I don't want that. It's going to cost you a lot of money to have me go through that. But here is what we're really trying to get. We just need a nice list and how much you spent in it. I don't need to see every receipt that made up this $300, but you do. You need to have these receipts. So I tell people, make folders and label them to these categories. And when you have a receipt for advertising, you throw it in the receipt folder and you add it to this cell. And then when you're done, you can just print this out and give it to me, and then I can put it where it needs to be on the tax return. And then if we get audited and they say, well, you got $1,500 for accounting fees, show me the invoices for your accounting fees. You can just pull out the folder, it was listed accounting fees, and bada boom, bada bing. You can show them exactly what the receipts for your accounting fees. So a lot of people love to make folders with the vendor names on it, but that gets big and oftentimes you'll end up with a bunch of folders with just 1 or 2 invoices in it. I like to make folders with the categories so that they'll tie in. We can pull our folder out for accounting fees and it'll have $1,500 of invoices in there. So it makes it really nice and handy. So this is what we're looking to get from our clients. Now, what can I not deduct? Well, here's where we might be spending it for it's ordinary and necessary, it's reasonable, it has a business purpose, but we just can't deduct it. There's very few. One of the big one, expenditures from drug dealers. You know, in reality, I've never seen this because, you know, drug dealers aren't the most tax compliant people in the world, so we don't often run into this. But for some reason, there is in the tax law where it says, you know, we've already talked about gross income includes proceeds from illegal activities. So drug dealers have to report their income, but by law, their expenses, including their inventory purchases, are not allowed as deductions. So yeah, this is what we're just talking about. They must report their income, but they're not allowed any deductions. Personal and living expenses. There's no business purpose for these. These are by their definition, personal, not business. And so you are not allowed to deduct anything related to your house or your personal just living expenses. There is a way to take part of your house off, and we'll talk about that here a little later on. Capital expenditures. This is one where people often get a little confused. They'll go out and they'll buy a $50,000 piece of equipment and think they get to write it off in this year. And I have to tell them, no, we have to capitalize that and depreciate it. And equipment is often 7-year property. So we're going to have to take 7 years to recover that $50,000 of expenditures that you made. And this is where when people don't talk to their CPA first, they get a little confused. They think, well, I have a $50,000 profit, so I'm going to go out here on December 31st and buy this $50,000 piece of equipment, and now I will have zero profit and I won't have to pay any income taxes. And then they come to me and I tell them, well, that's not quite how it works, and here's what's going to happen. Of course, if you remember, we talked about Section 179 in Chapter 2. And so there is some ways where we could write some of that, more of that off than just normal depreciation. And we get to that a little later on. Expenses related to tax exempt income. Now, this doesn't affect most of my clients because they're in it for a profit motive. But if you're making tax exempt income, then you are not allowed to deduct expenses that are related to generating that tax exempt income. And that kind of makes sense. You're not going to pay tax on the income. So why should you get to deduct the expenses that you incurred to help you earn that tax-exempt income? But again, we don't run into this very much. Churches and pastors, they have some issues with this, especially pastors because of what's called the housing allowance, where they're allowed to exclude from their income certain amounts of money related to their housing. But then that means they can't deduct a certain portion of their property taxes and mortgage interest and things of that nature. Fines and penalties. If you have people who drive, down the highway for you to deliver your goods and they get a speeding ticket, then you're not going to be able to deduct that. One of the big ones I see in the fines and penalties area are filing sales tax returns late. Here in Texas, it's an automatic $50 penalty if you file your sales tax return late, then that $50 would not be deductible because it is a fine or penalty. And then lobbying expenses. Doesn't matter what you're lobbying for. If you are paying money to lobby Congress to do certain things, you are not going to be able to deduct those expenses. Now, we talked about the Schedule C, and that's the most common form we use, but there's also this other thing called a Schedule CEZ, and I don't know why they make it. It's super simple, and maybe this might be one where you use it if your grandma's making the quilts and sells 1 or 2 quilts a year, then you might want to do it. There's some rules right here that you can see on how you can use the Schedule CEZ, and you can see it's super easy. You have income, expenses, and net. So 3 lines versus the multitude of lines we saw in the other one. But again, I don't suggest using it. Just use the regular Schedule C.